Right friends, welcome back to Banking Awareness. This is the 14th module. In this 14th module, we are going to discuss important terminology in banking, and we are going to discuss the difference between quantitative and qualitative credit controls, the difference between public sector and private sector, then private limited company and public limited company. What is the difference between disinvestment and privatization? What is the difference between fund-based support and non-fund-based support? Then performance guarantee and letter of credit. These words we are going to discuss in this module. Please listen to carefully. And first and the foremost is quantitative credit controls and qualitative credit controls. What is meant by credit control? That is controlling the credit offtake. Credit offtake is controlled by squeezing the money supply. What will happen? By squeezing the money supply from the system, what RBI will do is, by squeezing the money supply, then it will try to increase the interest rate. When the interest rate is increased, then automatically credit offtake will be reduced. That's what we have learnt in the previous lecture, and this falls under quantitative credit control. Whatever we have learnt in lecture number 13, that is as part of monetary policy of Reserve Bank of India, whatever RBI does, that is repo rate and its associated rates, reserve ratios, open market operations, we have discussed in detail. These are the methodologies adopted by the Reserve Bank of India to control money circulation in the system, or you can say to reduce or increase interest rates in the banking system, right? So here these are all fall under quantitative credit controls. Exactly whatever we have learnt in module number 13 is a part of a quantitative credit controls exercised by Reserve Bank of India. By increasing the money supply, by reducing the money supply, RBI will try to control the interest rate regime in the market, right? So the quantitative credit controls are this bank rate. Bank rate is connected with repo rate. Repo rate is for overnight lending. Bank rate is for long-term lending given by Reserve Bank of India to banks and other financial institutions. There the collateral security will be government securities, and by increasing repo rate, automatically bank rate will also increase. Once the bank rate is increased, then automatically the interest rate structure will increase in the market. That's why repo rate is very important. By increasing or reducing the repo rate, Reserve Bank of India is giving the signal to the market with regard to the interest rate regime. The second point is reserve ratios, cash reserve ratio and statutory liquidity ratio. We have discussed in detail. By increasing cash reserve ratio or statutory liquid ratio, or by reducing CRR or SLR, RBI will try to control money circulation in the market. By controlling money circulation, it indirectly controls the cost of credit, or you can say it indirectly controls inflation. Third one is open market operations. By buying or selling government securities in the market, RBI will try to control money supply, and these are called quantitative techniques employed by the Reserve Bank of India for credit control, in turn to reduce inflation. Second is qualitative or selective credit controls. Selective way, RBI may give instructions from time to time, that is also with a view to control credit. And these are qualitative or selective credit controls. Quantitative credit controls will be applicable universally across the banking system, and this qualitative will be useful for sector wise, or depending on the need, RBI will look at each one of them. The first one is margin requirements. If you are constructing a house, if the house cost is 1 crore rupees, banks, depending on the instructions, may give loan up to some extent. If the margin money requirement is 20%, they can give loan up to 80 lakhs. If the margin money required is 10%, they can give loan up to 90 lakhs. If the cost of the building is 1 crore, if the margin money required is 10%, banks can give loan up to 90 lakhs. If the margin money required is 20%, that means the money which is required to be arranged by the borrower. So, by changing the margin money requirements, it indirectly controls the credit in the market. The second one is rationing of credit. It may impose restrictions on the banks. The maximum limit of issuing loan is this much. Don't go beyond that. Like that, it can impose restrictions on the banks. That is the rationing of credit. Third one is regulation of consumer credit. For consumer durables, sometimes it may impose restrictions. Maybe sometimes vehicles, purchase of vehicles, sometimes on purchase of consumer durables like refrigerators, like air conditioners. RBI may impose restrictions, that is the regulation of consumer credit. The fourth one is moral persuasion or moral suasion. Moral persuasion means by giving instructions or by pursuing the banks to exercise restraint while granting credit. Fifth one is direct action. That means if the instructions are not followed or not being followed by banks, then RBI can take direct action, and RBI guidelines is the sixth one. RBI can issue guidelines from time to time. So these are all the part of qualitative credit controls exercised by Reserve Bank of India. So quantitative are different. They are part of monetary policy, and qualitative are issued one by one depending on the need. So this is the difference between quantitative and qualitative. Both are with a view to control credit. Right? Look at the next one, public sector and private sector. What is the difference between public sector company and private sector company? Please look into left side. I have given the total ownership of 100%. Out of total ownership of 100%, if the government or government agency or government department holds minimum 51% of ownership, then it is called public sector. If the total ownership is 100%, please look into this visual, it will be clear to you. If the total ownership is 100%, then the entity of government or its agency or its department holds minimum 51%, then it is called public sector. That means it is able to take decisions and it is the majority shareholder, and management control will be with the government. So they are called public sector enterprises. If you look at State Bank of India, if you look at the BHEL, if you look at the ONGC, if you look at NTPC, these are all examples of public sector enterprises. And private sector enterprise is owned by private individuals. They are not a part of the government. The shareholding is by private individuals. Government may not have any share, or government may have share up to 49%, then also it will be called private sector enterprise. When government is majority shareholder, it is public sector enterprise. If government has got nothing to say, it is totally owned by the private individuals or private entities, it is private sector. Government may have some shares, they may be minority shares less than 50%. And examples are Reliance Industries Limited, Vedanta Limited, Tata Steel, ICICI Bank, HDFC Bank. These are all examples of private sector enterprises, right? So when we are talking about public sector, you should not forget disinvestment or divestment. What is disinvestment? I have already told you, when the government shareholding is 51%, it is called public sector. But in most of the public sector undertakings, the government shareholding is around 70%, 80%, 90%. What is the need of having that many shares by the government? If 51% shares are held by government, it is considered as public sector, and there is no point in government holding 80% or 90% of the shareholding. That's why when the shareholding is reduced, but it should not go below 51%. Take this case. In this case, before disinvestment, the government shareholding was 80%. Subsequently, government disinvestment took place for 29%. Now the government shareholding is 51%. Selling of the shares in public sector enterprises by maintaining minimum shareholding of 51% is known as disinvestment or divestment. In the example I have given, 29% of shares are sold. What is the point in selling the shares? The basic reason is, if the government shareholding is more, 80% or 90%, it may become lethargic. It may not work effectively or efficiently. Nobody is there to question the government. If government holds 51% or 55%, balance is held by private individuals. In the board meetings, somebody is there to question the efficiency of the organization. That is one reason. Second reason is, by selling the shares, government will get back money. Government has invested a lot of money in the public sector enterprises. Government will unlock its potential by selling some of the shares. But mind it, the government shareholding should not go below 51%. By keeping minimum shareholding of 51%, government can sell the balance shares. That is called disinvestment or divestment. Every year, government gives a target for disinvestment. Please don't forget. What is privatization? Government shareholding, if it is maintained up to 51%, it is public sector enterprise. Let us assume a situation. Please look into this. Government shareholding is 80%. But government sold 50% of its shares and became minority shareholder at 30%. And assume another situation, government sold entire 80% stake. Government totally came out of the company. These two cases are privatization. Privatization means government coming out of that public sector enterprise, or government is keeping minority shareholding and selling majority shareholding to private individuals or entities. So, for public sector enterprises, one is the disinvestment, the second one is total privatization. If the public sector enterprise is not able to function efficiently, then there is no scope for its revival. Then government ultimately may privatize that public sector undertaking by selling entire stake to private individuals, but there may be resistance from employees sometimes. So this is the privatization. I hope that you are now clear about disinvestment and privatization. Now look at another classification: private limited company, public limited company. And please don't forget, we have discussed about public sector, private sector. Public sector, private sector talks about ownership either by government or not. But private limited company and public limited company. Private limited company is held by group of promoters. And at the same time, all the shares are privately owned. Shareholders here comprise a close group of friends and relatives, and they cannot sell shares to public, and it should indicate specifically private limited. And no stringent rules. This type of company is known as private limited company. Private limited company cannot sell shares to public. They cannot go for public issue, and the shares are owned by group of limited people or maybe their close relatives. This is a private limited company. I have given two examples: Eagle Software India Private Limited and Synergy Mentors India Private Limited. These type of companies are owned by private individuals. But look at the public limited company. Sometimes public limited company is written as simply limited company. Public is omitted. Please remember, if any company is written as limited, then it is public limited company. And here the owners are public in addition to the promoters. Owners are public, and here shares are open to anyone. Shares can be traded through stock exchanges. One can transfer shares to other, one can sell shares to other. So here the public ownership is there. That's why they are called public limited companies. So, in public limited companies, the stringent rules are to be followed and shares can be given to anyone. Shares are sold across the stock exchanges. And if you want example, you can see State Bank of India is public limited company, then NTPC, then ONGC, then Reliance Industries. I am not talking about private sector or public sector. If you look at it from public sector and private sector, Reliance Industries is a private sector and SBI is public sector. But if you look at the public limited company, both government companies and private companies can be public limited companies because the shares are given to the public. So, SBI, NTPC, ONGC, Reliance, these are all examples of public limited companies. So, I hope you are clear about public sector, private sector, private limited company, public limited company, disinvestment, privatization. Having known this, please look at fund-based support and non-fund-based support. What is fund-based support? When you go to bank, you take loan, that is fund-based support. When you are going for vehicle loan, when you are going for agriculture loan, when you are going for personal loan, when you are going for credit card advances, you will purchase something by using credit card, that is credit card advance, that is fund-based support. Then overdraft is revolving credit, cash credit, this is also revolving credit. Please don't forget whatever the examples I have given. Last 3 examples are examples of revolving credit. Credit card transactions, overdraft account, cash credit account, these are all examples of revolving credit and these are all examples of fund-based support. Fund-based support means you are getting some money from the bank. And look at the non-fund-based support. Banks sometimes will give non-fund-based support also. Examples of non-fund-based support is performance guarantee or sometimes known as bank guarantee, then letter of credit and solvency certificate. Solvency certificate is the certificate given by the bank if a customer wants, and solvency certificate indicates as far as the information known to us, this customer is solvent up to so and so limit, like that they will give certificate. There is not much great thing about solvency certificate, but these 2 items, that is performance guarantee and a letter of credit, are very important. Performance guarantee, let us see performance guarantee. Before going into that, please clear, one is fund based, the second one is non-fund based. This performance guarantee or bank guarantee and letter of credit comes under non-fund based support. Right? What is performance guarantee? Let us think about a big firm, agency XXX, which builds big buildings, big dams. The firm name is XXX. Its bank is State Bank of India. Firm is XXX. Its bank is State Bank of India. And firm XXX taken a big contract of 500 crores of rupees to build big buildings in Delhi from CPWD. CPWD has given a contract to XXX agency to construct multi-story infrastructure in Delhi. Then they will ask for some performance guarantee or bank guarantee. That means firm XXX has to construct the buildings as per the standards, and to ensure that firm XXX does not fail, this CPWD will ask performance guarantee. Here, State Bank of India will give performance guarantee to CPWD on behalf of XXX firm. Here, State Bank of India is not giving any money, but it is giving performance guarantee or bank guarantee to CPWD only with the condition, if my client XXX fails to perform the obligations, then you can utilize this money. That is performance guarantee. If my client failed to perform obligations, then it is giving right to CPWD to encash the bank guarantee or invoke the bank guarantee. If everything goes well, CPWD will not touch that bank guarantee. Right? So, the performance guarantee or bank guarantee is given by the bank on behalf of its customer to an agency with the condition that if my customer fails to perform duty, then you can invoke this bank guarantee. Right? Then the other one is letter of credit. Let us take an example. Please look into it. Buyer is in Chennai. His bank is State Bank of India. Seller is in New Delhi and his bank is ICICI Bank. Seller of some computers, let us assume. The manufacturer of computers, that is YYY firm, is in Delhi. It sent computers to Chennai and they are not personally known to each other. XXX and YYY are not known personally to each other. Under those circumstances, the bank of a buyer, that is buyer's bank, in this case State Bank of India, will give letter of credit to the seller, that is YYY in Delhi, that if my customer failed to pay to you after receiving the goods, then I will give payment on behalf of my customer, that is letter of credit. Letter of credit is given by the buyer's bank to the seller as a guarantee, stating that if my buyer fails to pay after receiving the goods, then I will pay. That guarantee in the form of letter of credit is given by State Bank of India, in this case to the seller YYY in New Delhi. Right? So, if the buyer XXX in Chennai fails to pay back after getting the goods, then the seller YYY will encash that letter of credit. Right? So, I think you are clear about performance guarantee, bank guarantee, both are one and the same, and letter of credit. So, with this, let us conclude this, and for more terminology, please do join for lecture number 15. Right? Have a nice day. Thank you.